In January of 2000, a sock puppet appeared on the world's most expensive advertising stage, the Super Bowl. This puppet was the face of Pets.com, a company spending millions of dollars it didn't have to sell products on which it lost money with every single sale. It was the peak of a delirium that had gripped the world, and in just a few weeks, it would all come crashing down. To understand how it came to this, we have to go back to 1995. On August 9th, a company called Netscape, which made a web browser, went public. It had existed for just over a year and had yet to turn a profit. But on its first day of trading, its stock more than doubled. For investors, it felt like witnessing the birth of a new world. This was the new economy. The story of the dot-com bubble isn't about technology. It's about psychology. The NASDAQ Composite Index, home to these new tech stocks, began a historic climb. In 1995, it rose 40%. In 1996, 23%. In 1997, another 22%. Suddenly, cab drivers were given stock tips. College students were becoming day traders. The core belief was simple. The internet changes everything, so the old rules of investing, like profits and valuation, no longer apply. And this belief created companies that were more idea than business. One was the Globe.com, an early social network. Another was Webvan, which promised to deliver groceries to your door within a 30-minute window. And of course, Pets.com, which aimed to sell pet supplies online. Each was backed by millions in venture capital, all betting on a future that hadn't arrived yet. The race wasn't for profit, it was for eyeballs. The mania went into overdrive on November 13, 1998. That day, the Globe.com went public. Its IPO was priced at $9 a share. By the end of its first day of trading, it closed at $63.50, a 606% increase. This was the largest first-day gain of any IPO in history. The two founders, both in their early 20s, were instantly worth hundreds of millions on paper. It sent a clear message: get in now at any price. Then came the big money. Webvan raised an astonishing $1.2 billion from investors before it had even proven its business model. The plan was to build a nationwide network of massive, fully automated warehouses, each costing $30 million. They signed a billion-dollar deal to buy a fleet of delivery vans. All of this for a company burning through cash with no clear path to ever making a profit on a bag of groceries. By 1999, the NASDAQ surged an incredible 86%. This wasn't investing, it was a lottery. Any company with .com in its name saw its valuation skyrocket. Analysts who questioned the sanity were fired. Legendary investor Julian Robertson, who refused to buy .com stocks, saw his fund underperform so badly that he was forced to close it down just before the bubble burst. To stay rational was to lose. And then, on Friday, March 10, 2000, the music stopped. The NASDAQ Composite Index hit its all-time intraday high of 5,132.52 before closing at 5,048.62. There was no single event, no catalyst. The market simply ran out of buyers. The belief that prices could only go up had finally, quietly broken. It was the beginning of the end. The fall was faster than the rise. By mid-April, just a month later, the index had lost nearly a third of its value. Panic set in. The companies built on hype were the first to evaporate. Pets.com, which had gone public just 2 months before the peak in February 2000, was a disaster. It was discovered they were losing money on almost every order because of shipping costs. The sock puppet couldn't save them. On November 7, 2000, just 268 days after its IPO, Pets.com announced it was ceasing operations. It had burned through over $300 million in investment capital. Shareholders were wiped out. Next was the Globe.com. With advertising revenue gone, their stock collapsed from its high of $97 to less than 10 cents. The company delisted from the NASDAQ and faded into obscurity. The biggest collapse was Webvan. After spending over $1 billion, the company was hemorrhaging cash. On July 9, 2001, it shut down all operations and filed for bankruptcy. 2,000 employees lost their jobs. The state-of-the-art warehouses were sold for pennies on the dollar. Investors, from venture capitalists to regular people who bought the stock, lost everything. The dream of 30-minute grocery delivery was dead. By October 2002, the NASDAQ had bottomed out at 1,114. It had fallen 78% from its peak. Over $5 trillion in market value, $5 trillion, had vanished. This wasn't just paper losses. It was retirement accounts, college funds, and life savings for millions of people who believed that this time it was different. For many, financial recovery would take more than a decade. In the aftermath, the landscape was littered with dot bombs. Hundreds of companies went bankrupt. But it's crucial to note what survived. Companies with real business models, like Amazon and eBay, took a beating but ultimately recovered and grew to dominate their industries. The internet wasn't a lie, the valuations were. The bubble didn't invalidate the technology, it just punished the speculation. And what about the investor who ignored the hype? According to research from Vanguard, a simple, globally diversified portfolio of 60% stocks and 40% bonds, while it did dip during the crash, recovered far more quickly. It captured the real, underlying economic growth, not the speculative froth. By staying disciplined and ignoring the noise, passive investors sidestepped the worst of the carnage. Their strategy wasn't exciting, it was effective. The dot-com bubble stands as a timeless lesson. Markets are driven by fundamentals over the long term, but by emotion over the short term. The desire for quick, effortless wealth is a powerful force, capable of turning sane investors into gamblers. The story reminds us that building real, lasting wealth is slow, it's boring, and it has nothing to do with finding the next big thing before anyone else.